Navitas Semiconductor is currently trading at $12.90 during this intraday session, marking a noticeable downward move of 4.52% as selling pressure accelerates across the tech tape. While the broader market watches tech giants navigate intense volatility, the true story for this small-cap chip designer is developing completely under the radar. Retail traders tracking the headline semiconductor space think this drop is just a routine cool-off after a massive mid-year spike. The real driver shifting institutional positions right now is an explosive, high-stakes legal battle that just landed on the company's doorstep. On July 8, 2026, industry competitor Wolfspeed officially filed a comprehensive patent infringement complaint targeting the core power chip designs that Navitas relies on for its future revenue. This structural pressure is colliding with a forced capital rebalancing as the company was quietly removed from the Russell 2000 and Russell 3000 indexes at the end of June. The market expects Navitas to simply slide back into its historical trading range until its next major financial report. But the reality is an institutional tug-of-war that is redrawing the risk profile of the entire next-generation power chip sector. To understand why this legal threat matters so much, we have to establish the common ground of the investment thesis. The conventional wisdom surrounding Navitas Semiconductor has long focused on the massive global shift toward energy efficiency. For a standard online investment or any self-investing plan, the stock looked like a direct, pure-play bet on the hardware enabling advanced power systems. The general expectation was that as large infrastructure projects required faster, more efficient energy conversion, this company would inevitably capture outsized market share. Many investors utilizing online investing platforms or traditional individual brokerage accounts bought into the narrative that legacy silicon was dead and that wideband gap materials like gallium nitride and silicon carbide would take over the tech world without friction. It seemed like the perfect asymmetric bet for a long-term investment, the kind of aggressive small-cap exposure people seek out when looking for specialized investment help on top-tier investing sites. The reality, however, is far more complex and dangerous. While the structural demand for efficient energy management is real, the competitive moat protecting this company is actively being chipped away by aggressive litigation and aggressive equity dilution. Wolfspeed's patent lawsuit is not a standard legal nuisance. It targets the precise manufacturing and design methodologies that Navitas uses to secure major hardware agreements. When institutional managers look at risk models on professional execution software or standard retail platforms like Robinhood stock trading, their primary concern is sudden operational disruption. Navitas immediately issued a public response disputing the claims and pledging a vigorous defense. They called the accusations baseless and framing the action as an anti-competitive tactic. Even if the company eventually prevails, a prolonged legal battle drains vital cash reserves at a time when profitability remains frustratingly out of reach. Looking closely at recent trading volume and order flow shows that institutional funds are adjusting their exposures aggressively. The daily swings have become increasingly erratic, with the stock collapsing from its recent multi-month highs near $28 down to this current $12.90 level. This massive compression was heavily exacerbated by the Russell Index deletion. When a company exits these widely tracked benchmarks, passive index funds are legally mandated to liquidate their entire positions regardless of the underlying corporate fundamentals. This mechanical selling created an artificial supply shock on the tape, overwhelming regular daily buying volume. Professional desks executing orders on the Interactive Brokers platform or managing large-scale assets through Fidelity Wealth Management had to navigate a severely distorted market structure for days. This forced liquidation window gave shorter-term short sellers an opening to press their positions, driving the stock well below its long-term volume-weighted average price. The near-term pressure is mounting as the market approaches the upcoming second-quarter financial results scheduled for July 27, 2026. Retail traders checking their portfolios on the Robinhood app or using SoFi Active Investing are bracing for high volatility. The previous first quarter report showed an 18% sequential revenue increase driven by early traction in high-power infrastructure sectors, but it also revealed a widening net loss that spooked conservative allocation models. The tension between top-line expansion and bottom-line stability is the core battleground for the stock right now. If the upcoming numbers show that cash burn is accelerating faster than design wins can convert into actual recognized revenue, the stock faces another structural leg down. Major asset managers using institutional platforms like Fidelity Brokerage or Advanced Interactive Brokers trading tools are intensely analyzing the company's capital allocation strategy, especially given the presence of an active at-the-market equity program that allows for up to $500 million in ongoing share issuance. This means that while management hunts for new business, existing shareholders face the constant threat of equity dilution. At its core, Navitas operates in a highly specialized niche within the global semiconductor supply chain. The company focuses entirely on next-generation power electronics, specifically developing gallium nitride power-integrated circuits and silicon carbide discrete devices. Unlike classic digital processors produced by companies like NVIDIA, which process complex information, power semiconductors regulate, convert, and distribute electrical energy within high-voltage systems. Their proprietary technology is designed to handle significantly higher voltages, currents, and switching frequencies than old-school silicon chips, allowing developers to build smaller, lighter, and vastly more efficient power supplies. Their business model relies on securing long-term design wins with manufacturers of consumer electronics, electric vehicle drivetrains, solar inverters, and hyperscale computer servers. Historically, the company grew rapidly during the early adoption phase of fast-charging mobile accessories, but it has since entered a difficult structural pivot trying to transition from low-margin consumer goods to high-margin, heavy-duty industrial infrastructure. This high-power pivot is where the company's long-term survival will be decided. Just a few weeks ago, management announced a direct collaboration within the specialized hardware architecture designed to support emerging 800-volt direct current data center setups. They showcased a specialized high-density power delivery board designed to run at high frequencies with massive power efficiency, aiming directly at the modern artificial intelligence infrastructure market. This is the massive upside narrative that speculative investors focus on when analyzing the stock through digital brokers like SoFi Invest or standard individual brokerage choices. The theoretical market opportunity here is massive. As massive server farms expand globally to power complex computation, the sheer electrical demand is pushing regional power grids to their absolute limits. If a data center operator can install chips that cut energy loss even by a fraction of a percent, the aggregate cost savings scale into millions of dollars annually. That is the expectation keeping the bullish narrative alive. Yet the stark contrast of reality shows a business model currently trapped in an incredibly expensive transition phase. While the long-term design win pipeline is reportedly valued at hundreds of millions of dollars, the near-term financial statements reveal deep quarterly net losses and negative operating cash flow. The company is spending massive amounts of cash on research, development, and scaling specialized production lines before those advanced industrial contracts actually begin shipping at scale. Comment below how many shares of Navitas Semiconductor you currently hold, or if you are completely avoiding this highly volatile chip sector right now. For retail market participants utilizing standard self-investing websites or checking their balances via the Fidelity mobile app, this fundamental mismatch creates immense psychological stress. The stock has historically been highly cyclical, prone to massive multi-month rallies when new partnerships are announced, followed by brutal drawdowns when the realities of the balance sheet catch up to the hype. Looking out into the second half of 2026 and beyond, there are two distinct fundamental paths for this stock, both rooted in the tension between narrative and execution. The bullish case relies entirely on a rapid resolution of the current patent dispute, alongside concrete evidence of revenue stabilization during the upcoming earnings call. If the legal team can quickly dismantle the competitor's complaints or secure a favorable cross-licensing agreement, it removes the dark cloud currently hanging over institutional asset models. Furthermore, if the upcoming financial report confirms that the high-power infrastructure business is growing fast enough to offset the structural weakness in legacy electric vehicle and solar end markets, institutional buyers will likely return. Analysts who maintain aggressive buy ratings and high price targets are banking on this exact operational inflection point, believing the current price compression offers an entry window for a deep value tech asset. Conversely, the